I'm joined now in Cape Town by Graham Bell. He's a strategist at Old Mutual Equities. Graham, so good to speak to you as always. Let's pick up with the big news item for this week. It has to be all eyes on the US and the Fed FOMC meeting, to hike or not to hike. Many people actually expecting that we'll hear the P word being used again, being patience.
Hi there, Gugu. Yes, we're in June now, so June was a month that a lot of people were focusing on a few months back for the first Fed hike, but that started to drift off when very weak data came out from the US during the first quarter, and Yellen and other members of the Fed board came out and indicated that for the time being it was unlikely that a hike would take place. Most recently we've seen some pretty strong data coming through in the US, retail sales, the housing data, and all the way through this period jobs numbers have been pretty good, especially unemployment claims, initial claims. So it's not likely that they're going to hike this time, but the guidance for the first hike is likely to become a little bit more strident, and the language that they use will probably lead people to expect the first hike to come through in September. And it's interesting that over the last few months there's been quite a convergence of views. Some people had expected, the hike in June, and others had expected the first hike only next year. But the range of views now, I think, has narrowed significantly around the September period. So that looks like it's going to be the one.
Maybe if you can walk us through both scenarios, whether they hike interest rates or keep them steady. What kind of impact are we expecting to see on equities as well as the bond market performance here?
Well, if they hike, then you need to put on your bulletproof raincoat, because that would be a big shock. And the Fed has been very careful to provide significant market guidance ahead of the time, so that that kind of a shock doesn't actually take place. A lot of investors remember in 1994 when the Fed hiked quite aggressively without giving any forward notice, and there was a bloodbath in markets for a while. So it seems very unlikely. It's possible, and if it happens, it won't be pretty. If the language indicates that the most likely move is in September, I think that markets are going to stay pretty volatile. We've been expecting the volatility all the way through, because this is going to be the first hike in the Fed funds rate since 2006. We've been waiting for it for a long time. It's been talked about for ages, but there's still uncertainty about it and what it'll all mean. My own view is that they won't hike this month, and when they do hike in September, they're going to give guidance pointing to a very slow rate of ascent and an extreme degree of caution. And remember, as I've said many times on the show, rates will still be extremely low. So I think we'll get through the volatility, and the market actually looks a little bit oversold at the moment, particularly South African equities. So if it's a reasonably relaxed comment today, then I think we could actually even see a short-term rally.
Another cause for concern has to be the deadlock in talks between Greece and its international counterparts. It almost seems as though there's no progression there, so it could potentially not be able to pay up its debt and also fall out of the Eurozone here. Your view on the nervousness that this is also adding to the investor sentiment at the moment?
Yes, this is a big overshadow in the markets, and it's a long drawn-out process. So we have Thursday, we have Eurozone finance ministers meeting. Next Thursday, Friday, we have heads of state meeting, and then the following Monday, a large payment is due to the IMF by Greece, about 1.6 billion euros. Now, you simply don't miss your payments to the IMF. They've already missed one, but they've kind of bundled it up for the month and skated by that one. If you don't pay the IMF, you're basically in default. And then you've got severe ramifications. Looking a little further ahead into July, on the 20th, they have a big payment due to the European Central Bank. So Greece desperately needs the support of the European Central Bank just for its own banks. If they don't make the payment to the IMF and they don't make the payment to the ECB, then they really have to implement stringent capital controls to prevent people from taking money out of the banks and running for cover. So it's really getting down to the wire. As I mentioned, the Eurozone heads of state meet next week, at the end of next week, and that really is the last time for any kind of political deal to take place. But then it could run for a while, in the sense that they may default to the IMF, they may implement capital controls, but then they might still come round to their senses and decide that they want to stay in the Eurozone, which the bulk of the population still wants to do, and find a way of meeting their obligations. So it could still happen, but in the process, already we've seen a lot of volatility and concern in markets in Europe in particular pulled back, and bond yields have been rising. And we're likely to see more of that over the next few weeks until this issue is resolved.
Graham, it will be interesting to see how all of this unfolds for the duration of the week, but always great speaking to you, and thank you so much for your insightful analysis today. That was Graham Bald. He's a strategist at Old Mutual Equities.